in our last session, almost 10 days before, we were discussing regarding net operating income approach. And I hope you do remember what is net operating income approach. Now, according to NOI approach, it tells whatever decision you take regarding capital structure, it is irrelevant. And it tells the reason for the same. It tells it is irrelevant because whatever advantage we get by using debt more and more, it would be offset because of increase in the cost of equity. The decrease and increase would be equal, and therefore capital structure decisions are irrelevant. And we had seen the assumption, presumptions, some of the formulas, and we had also discussed regarding the first problem and the second one. And if we remember, when we compare net operating income and net income, the difference is in the calculation of the total value of the firm. Yes? How do you get it under net income approach? We okay. Yes. Under net operating income, it is V is equal to okay. NOI. Okay. See, it is only a matter of difference. Know it in particular. Okay. That is the one thing which makes net income different of NOI approach. Both the questions, or for that matter the questions of all the four, resembles the same. Okay. Now your hypothesis would be entirely different. You need not worry regarding that. You do not have problems under traditional approach either. But then NOI and NI, in the how you evaluate the value of the firm, that would be a bit different. Fine. Now, second problem also we had discussed. So, in our today's class, we shall see the third question. Okay. Okay. Please do go through the problem, read it out so that you understand what components has been given and what has been asked of you. Okay. Now, assume operating income of rupees 50,000, cost of debt 10%, outstanding debt rupees 2 lakhs, overall cost of capitalization 12.5%. What would be the value of the firm and equity capitalization rate as per net operating income approach? Continuing further, they have given you two different distinction in the question. The first one is the company decided to raise rupees 1 lakh by issue of 10% debenture and use the proceeds thereof to redeem equity shares. B. The company decides to redeem debentures by issuing equity shares of rupees 1 lakh. Now I'll give you one more minute for all of you to read the question once again, and whoever wants to take down, do take it down. Now concentrate on the question. The things that they have given is, first one is operating income, and it stands at rupees 50,000. Now if you have remember, operating income is nothing but what we call as earnings or profit. And when we come to all this capital structure, the assumptions are that there is no income, there is no corporate tax. That's where we tell it is earning before interest and tax. So your operating income is nothing but EBIT. Now cost of debt is what? How do you represent cost of debt? It would be either KD, where D represents debt, or you can also call it as KI, where I represents interest, because on debt we give interest. So it stands at 10%. Usually when we work out problems, we tend to take it as into 10%, or somewhere might be chances we can take it as 0.10. Now, if cost of debt is given, we'll have to simply, it means that we have to pay interest. But for paying interest, we'll have to know the face value of the entire debt so that we can calculate what is the interest amount. If at all they would have given it directly, no issue, right? So the outstanding debt is standing at 2 lakhs. So 2 lakh into 10% would come up till 20,000. Then overall capitalization rate. Now overall capitalization rate or overall cost of capitalization is nothing but what we call as K naught. So the cost of debt plus cost of equity makes the overall cost of capitalization. It stands at 12.5%. And when we convert it, it would be 0.125. So how do we get that is nothing but 12.5 divided by 100. Now if somebody just forgets, it is nothing but 12.5 per cent is nothing but 100. Okay, 12.5 divided by 100 is 0.125. So these are the information given, and they have asked you to calculate the value of the firm and also equity capitalization rate. Here you have overall cost of capital K naught, you have KD. You'll have to find out KE. Okay. Now it depends upon you. If you want, you can calculate for this particular in one table. Later you can take the next one, or you can do all together considering it as three different situations. So if this makes up the first situation, in the second situation, the thing is that the company decides to raise the company decides to raise rupees 1 lakh by issue of 10% debenture. So here debenture is nothing but a form of debt itself. So in the second situation, there would be increase in the total value of debt, and it increases by rupees 1 lakh. Okay, you will have to consider the grammar also here. Sometimes there might be chances that the company decides to raise the debenture to 4 lakh, if at all that is the sentence. What happens? Now the sentence is the company decides to raise rupees 1 lakh. So for this 2 lakh you would be adding 1 lakh. If at all the problem is such that they have given the company decides to raise the outstanding debt to 4 lakhs, then how much would be the addition? 2 lakh is addition. Okay, so you'll have to be careful regarding the grammar part also here. By n2, okay, it is by, so you simply add 2 plus 1. If it was here something else and if it was 2, the difference you would be adding. Okay, and this particular part, for us, for this particular problem or this kind of problems, it doesn't actually matters, right? We are concerned with the value of the firm V and the cost of equity K. That will make up the second situation. The third situation is that the company decides to redeem debentures by issuing equity shares of rupees 1 lakh. So what happens here? What happens here? Here the company decides to redeem. What do we mean by redeem? To give back. Okay, so whatever is there out of the total debt, 1 lakh of that they are redeeming. Why did we consider that 1 lakh is being redeemed? Because the same 1 lakh they are giving it in the form of equity shares. So we considered out of 2, 1 lakh they are redeeming. So this would make up 3 different situations. So we shall move with forming a table. What will you write? You need not write given, for that matter even table also, but then it would present your answer in a better way. Or for the one who corrects it, it would look in a crisp, clean manner. So the value of the firm under net operating income approach. Okay, all those things has not been written here. So you would be writing particulars. You can write situation 1, situation 2 or situation 3. Or here in this particular thing, we have taken it as rupees, and the second situation there has been increase in debt, and third situation there has been decrease in debt. Now all these things entirely depends upon you how you would like to present your answer. Now the two things that you will have to require when calculating value of the firm under NOI approaches: earning before income and tax and overall capitalization rate. If you have those two, you can easily find out the total value of the firm, because value of the firm under NOI approach we can calculate by dividing K naught from EBIT, or what we call as earning before interest and tax. Now according to the question, for all the three situations, EBIT stands at 50,000 each. And the next information which has been given in the question is K naught. And they have given it as overall capitalization stands at 12.5%. Okay. Now if you need, you can also try, okay. Before that, 12.5% divided by 1 lakh. Wait, I will tell. Okay. Now, K naught here in the question they have given 12.5%. When you simplify 12.5 by 100, you will get 0.125. So value of firm B is equal to EBIT divided by K naught. I might be telling this one simple formula maybe 100 or 1000 times, but then these simple formulas are the ones which you forget when you have to write your semester exam. Okay, so for that matter, E by 10 cannot, if you do not simplify it to 0.125, here you will have to multiply it by 100 to get this particular value. Okay, so because the EBIT and K naught are same for all the three situations, the value of the firm also stands at same for all the three, and it stands at 4 lakh for all the three situations. Now, since we have found out or finished with the first criteria, the second thing that we'll have to find out is the cost of equity. Before finding out the cost of equity, we have to know the value of equity. So when we have the value of the firm, and because in question they have given or mentioned regarding debt, if we deduct debt from value of the firm, we are going to get the value of equity. In the both the approaches, we tend to represent equity with the symbol yes or notation yes. So debt, what have they given in the beginning? The debt stands at 2 lakh. So that has been directly given. So we have taken 2 lakh for the first situation. In the second situation, what have they mentioned? That the company decides to raise rupees 1 lakh. Okay. So already there was 2 lakh as per the question, and now the company decides to raise one more lakh in the form of debt. That's how you got 3 lakh. So if at all this 3 lakh you cannot make out how did it come, please do mention might be in small brackets 2 plus 1 or 2 plus A also you can write here. Now moving towards the third question, what is the value of the debt? You had 2 lakh in the beginning. So what has been mentioned in here? The company decides to redeem debentures. That is, to a part they are telling goodbye for the debt that is there. So they did that by issuing equity shares of 1 lakh. So we are considering that out of the total debt, 1 lakh has been redeemed. So out of 2 what you had, when you redeem 1 lakh, what remains is 1 lakh of debt. So to find out the value of equity, we have value of the firm. From that we have to deduct value of debt. So for the first situation, we'll get 2 lakh as the total value of equity. For the second situation, we'll get 1 lakh as the total value of equity, and for the third situation, we will get 3 lakh as the value of debt. Now, according to the question, we'll have to find out the value of equity or KE, and the formula of equity is earning before interest and tax minus I divided by S. So we have calculated the value of S. We have the value of EBIT. What we have to find is the value of interest. Okay, if at all the total value of interest was given directly in the question, we would have simply skipped this step and directly started with this particular thing, this particular step. Okay, but since the value of interest has not been given directly, we'll have to find it out. And according to the question, what is the cost of debt that they are speaking of? See, interest is nothing but cost of debt. KE is cost of equity. Yes, we are still here in the interest part. Okay, so interest is cost of debt. When you have the face value of debt and the cost of debt, we can easily calculate it by multiplying the two. So and for cost of debt they have given for first situation, yes. For the second and third we are assuming that it stands at the same. For the second also they have specifically given. So for the third one it is nothing but out of the 2 lakh which is remaining, we are redeeming it. So for all the three it stands at 10,000. So 2 lakh into 10% would be 20,000. 3 lakh into 10% would be 30,000, and 1 lakh into 10% is 10,000. Now you can entirely skip this particular step if you do not want. Okay, you have I, that is what was necessary. You had already calculated, you have been given with EBIT. Yes, you have calculated the value of I, you have the value of yes. So this step if you do not need, you can skip it. Fine. If at all it is confusing, you can skip this particular step. So K is nothing but EBIT minus I divided by yes. So for the first one it is 50,000 minus 30,000 divided by 2 lakh. What is the value? Tell me the 4 digits. 0.15. Okay, it is 0.15. For the next one, it is 50,000 minus 30,000 divided by 1 lakh. What is the value? 0.2. And for the last one, it is 50,000 minus 10,000 divided by 3 lakh. Okay, 0.133. Now the standard is that we should write 3 digits. Okay, so you can write 0.13. So whatever was asked in the question, we have calculated both of it. Yes. Now what you have to give? First you have to give working note where you will tell the corporate according to the assumption. According to the assumption, there are no any, there are no any corporate tax, there are no any corporate tax to be considered. What is the one more thing that we have assumed? Since under situation 3, they have issued 1 lakh of equity shares. Since they have issued 1 lakh of equity shares, and they have mentioned the redemption of debentures it is being considered that out of total debt out of total debt 1 lakh has been redeemed. Okay, that is enough. Now, what is the conclusion you would give? What is the conclusion you would give? First, what we have to write? Whatever they have asked to calculate, we have to write according to the net operating income approach. According to the net operating income approach, the value of firm stands at rupees 4 lakh for situation A, B, and C respectively, or for all the situation, or whatever you have considered it as. Okay? And the equity capitalization rate, or KA, and the equity capitalization rate stands at 0.15, 0.2, and 0.133 for situation A, B, and C respectively. So now since it is net operating income approach, usually you will have to prove what the approach tells. Yes? So what will you write? Take down. This might be helpful for you. The significant feature, yes, continue. The significant feature is that equity capitalization rate increases with the increase in degree of leverage. Full stop. This is due to the effect of this is due to the effect of implicit cost. Full stop. As per net operating income approach, as per net operating income approach, it is proved that the value of the firm has remained unchanged at rupees 4 lakh, at rupees 4 lakh, even when even when the capital structure even when the capital structure has changed. Okay. Now if you want, you can see in the formula also. See here there is increase in debt. Yes, when increase in debt has happened, what has happened? Compare this. There has been increase in value of equity, I mean cost of equity. Yes, but then even though the capital structure there has been changed. See, all three different situations, the capital structures are different. Here it is 2 is to 2. Here it is 3 is to 1. And here it is 1 is to 3. Yes, that is not going to affect the value of the firm, because the value of the firm is standing all at the same. So thereby we completed the third problem. So shall we move on to the fourth one? Now anyone among you, if at all you have chance or access for earlier question paper, please do go through those and do solve it. Okay? Might be some of your friends who are studying in different colleges, they might have an access. If at all, collect it and start solving it. Okay? Okay. This had to be a homework problem, but then you'll sit and solve. I'll give 10 minutes. Once after reading this question, you'll have to solve it. Now do go through the problem. The problem states that firm MN and firm XY are similar in all respects other than the degree of leverage. The following are the financial data of both the firms. Analyze the impact of leverage on the value of the firm and also the cost of capital. And they have provided you with information. They have given particulars. First column represents all the information regarding the firm MN, and the third column represents all the information regarding firm XY. Now earning before interest and tax or EBIT stands at 15,000 each. K naught or cost of capital or overall cost of capital, or for that matter equity capitalization rate, stands at 0.17. I, they have given 1500 for firm MN and 3500 for firm XY. KI has been given as 12% for both. See, make changes in your question. Here they have asked the firm and cost of capital. Cost of capital is nothing but K naught. They have given it directly. You need not find. What you have to find is cost of equity. Okay? You'll have to find out cost of equity. Or wait until. So, let us discuss. Now see, they have given in particular the information. EBIT has been given, K naught has been given. Instead of cost of debt, how they have mentioned in earlier problems, here they have given the value of debt, or this 1500 and 3,500 is nothing but here they have mentioned in rupees. Okay, and they have also given cost of debt. Okay, it is 12%. Now, what do you have to find? The first one is value of the firm. V is equal to EBIT divided by K naught, and it is easy according to the question. The next one you'll have to find out is cost of equity. Cost of equity is nothing but KE is equal to EBIT minus I divided by S. Now this information they have given it easily. EBIT is there, I is there. What we have to find is the value of S. Value of S is nothing but it is the value of equity. And according to NOI approach, we find the value of equity how? S is equal to V minus B. So we have value of the firm V, we have B, we do not have. But there are information how we can calculate the value of B. Usually they would be giving it directly, but if they have not given directly, what they do is they give total value of interest and cost of debt is anyhow given. So when you divide the interest amount, total interest amount from cost of debt, you will get total amount of debt. Okay, or it is nothing but B is equal to I divided by KI or KD. Accordingly, what you represent. Okay, so then you will be getting value of B. You have total value of the firm. So from that, when you deduct the value of debt, you will get yes. The rest is same. So when you do a table, write calculation of total value of the firm under net operating income approach and particulars MN and XY. EBIT has been directly given, that is it stands at 15,000 for MN and XY, and K naught they have given it is 0.17 for each. How did we get that? 17 divided by 100. Okay, and the value of the firm V is nothing but EBIT divided by K naught. Okay, here you would not be getting a whole number. Okay, it would be in some fractions 88,235 point something. Okay, depending upon the fraction, adjust the last number. Whenever 0.5 and above, there would be an increase in the last value. If at all it is below 50, the last number would be standing the same. Okay, so the value of both stands at 88,235. And now we'll have to calculate K. Yes, we have EBIT, we have I, but yes, we'll have to find. And the formula of yes is nothing but yes is equal to V minus B. Here again we have value of B, but B we do not have. And the value of B, according to the information that has been provided, we can find it out by total value of interest that has been given divided by cost of debt. See the difference here. Whenever it is total value of debt, they represent it in capital I. Okay, whenever it is cost of debt, they represent it in small letter I. That is the difference. Or here you can also make out, here see, this is rupees, this is in value, rupees, right? It is not in percentage. because percent whatever it is, it should be 100 or below 100. Above 100 usually they would not give. Yes. So you have the information I, it stands at 1500 for Mn and 3500 for Xy. And Ki they have given 12%. And when you divide 12 by 100, you will get 0.124 both. The value of debt is B is equal to I divided by Ki, and when you calculate for Mn you would be getting 12,500 and for Xy you will be getting 29,167. Since you know the value of firm and value of debt, we can find out the value of equity. Yes, it is S is equal to V minus B. And when you calculate, the value stands at 75,735 for firm Mn and it stands at 59,068 for firm Xy. Now once you have found out whatever is necessary, we can calculate the cost of equity. And the formula for cost of equity is KE is equal to EBIT minus I divided by S. Now EBIT stands at what here? It is 15,000. Minus I is for Mn, it stands at 1500. For Xy, it stands at 3500. Value of S is 75,735 for Mn and for XY it is 59,060. When you calculate, you will be getting it as 0.18 and 0.1995. It is 0.18, 1.1783, and this one 0.195. So in conclusion, you can also convert it. So the cost of equity for Mn stands at 17.83%, isn't it? That's why it is 0.1783. And for XY, it stands at 19.5%. See once again here. Here the interest, there has been increase. Yes, from this to this when you compare. It simply means the total amount of debt has increased. So according to NOI approach, when the debt increases, there has been increase in cost of equity. So NOI approach is once again proved here. So give working note and write conclusion. Okay? Yes. See, a conclusion and working note stands the same as your last problem. But then previous problem, the second working note you need not give. Yes? Shall we move on to the next question? Okay, now before start writing, concentrate on the question. Yes, this had to be your homework problem, but then we are solving it. So I will give you enough time. But before starting, just concentrate here. Okay. Now see the problem. Assuming no tax and given EBIT, interest rate at 10%. Okay. Interest rate at 10% and equity capitalization rate as given below. Calculate the total market value of the firm, and also determine the weighted average cost of capital for each of the firm. Okay. Now the different firms are X, Y, Z and A. Now EBIT stands at 2 lakh, 3 lakh, 5 lakh and 6 lakh respectively. The interest stands at 20,000, 60,000, 2 lakh and 2 lakh 40,000. KE is 12%, 16%, 15% and 18%. Calculate. Now the question has been given. Tell me which approach is this? It is net income approach. Yes, concentrate here. Yes, concentrate here. Now see, usually one thing you remember, when it is net income approach, they would have given cost of equity. When it is net operating income approach, they would give cost of debt and ask you to find out cost of equity. So that is one point where you can find out whether the question is regarding net income approach or net operating income approach. Yes, here they have provided with cost of equity and they have asked you to find out the value of the firm. So you will have to solve how you used to solve under net income approach. And not only that, they have also asked you to determine the weighted average cost of capital. Yes. Now remember NI approach. How we used to calculate? What is the first thing? Usually we write EBIT. Yes. Then you deduct interest from EBIT so that you get net income before tax. But according to the assumption, since there are no tax, you consider the same thing as the amount available for shareholders. So once you find out that you have KE which they have given in the question, it is 12, 16, 15 and 18%. You can find out the value of equity. Yes, value of equity is S is equal to NI divided by KE. And once after you find out the value of S, you will have to find out the value of debt. Because there is lack of information, you will be finding it as B is equal to I divided by KI. Because under net income approach, the value of the firm is nothing but V is equal to S plus B. And once you find out the value, you can easily find out the value of weighted average cost of capital for each of the firm. Okay. Or you can simply consider it as cost of capital or K naught. Now it okay. So this is how you used to calculate net income approach. Start solving it. Write table showing valuation of firm, valuation of firms under net income approach. Okay. First we'll be writing EBIT. Now EBIT they have specifically given for each of the firm. It stands at 2 lakh, 3 lakh, 5 lakh and 6 lakhs for firm XYZ and A respectively. Now, interest also they have specifically mentioned, which stands at 20,000, 60,000, 2 lakh and 2 lakh 40,000. So, when you deduct interest from earning before interest and tax, you will be getting it as 1,80,000, 2,40,000, 3 lakh and 3,60,000 for company X, Y, Z and A respectively. And according to the assumption of net income approach, there are no any tax. So the net income before tax itself becomes net income available for equity shareholders, and it stands at 1,80,000, 2,40,000, 3 lakh and 3,60,000 respectively. Now, KE or cost of equity has also been specifically given in your question, and it stands at 0.12, or in question they have given it as 12%, 16%, 15% and 18% respectively. And when you convert, it would be 0.12, 0.16, 0.15 and 0.18 respectively. So to find out the value of equity, it is nothing but S is equal to Ni divided by K. So the value of equity for each of the companies stands at 15 lakh for company X and Y respectively, and 20 lakhs for company Z and A respectively. And the value of debt stands at 2 lakh, 6 lakh, 20 lakhs and 24 lakhs respectively. Therefore, the value of the firm is nothing but S plus B, and it stands at 17 lakh, 21 lakh, 40 lakhs and 44 lakh respectively. The first thing what they have asked in the question, the value of the firm. Did you find out the value of the firm? The next thing what have they asked? Is it? They have asked weighted average cost of capital. What did you find? You have found cost of capital and you have stopped there. Whether cost of capital and weighted average cost of capital one and the same? I have stopped it there because the rest is your work. 64%. So that is the cost of capital for 4 different firms. So now whether cost of capital and weighted average cost of capital one in the same? Who said? What did I say? What did I tell from the beginning of capital structure? What I have started? neither in my notes, nothing more is there, only so much. I have stopped it there. Yes, remember one thing, whenever in exam they have given, see to that when cost of equity is given, okay, when cost of equity is given, and if at all they have asked you to find out cost of capital, K naught, those particular problems belong to net income approach. The first one, which tells as and when the capital structure changes, the value of the firm also changes. Okay, whenever in the question you see cost of debt and they have asked you to find out cost of equity, those belongs to NOI approach, because NOI approach is the one which tells whenever the debt increases, cost of equity also increases. Okay, that you remember. Now here you have found out cost of equity, fine. But what is the formula for weighted average cost of capital? You will have weights for each of that. You have cost of debt, you have cost of equity, you multiply the two, you add the two, you will get weighted average cost of capital. What is the formula of weighted average cost of capital? See, anymore it is your work, you will have to do. What is the weighted average cost of capital? Yes, under cost of capital, K naught is found how? It is found by K naught is equal to EBIT divided by V. What is weighted average cost of capital? K naught is equal to, you have cost of equity which you will multiply with weight of equity. For that you would be adding whatever value you get by multiplying cost of debt by weight of debt. This what makes your weighted average cost of capital. Yes, concentrate here once again. KE they have directly given. Yes, so this not a problem. Fine. KI they have not given. Here have they given KI? Okay, they have given? Yes, fine. Then your work is easy, right? Now weights, how will you assign weights? WE and WD. See, here you have both. See, here you have the value. See the proportion. Out of 17, how much is 15 lakhs? See, how much is 15 lakhs? If 17 is 100, what is 15? Calculate faster. Cross multiply. See, don't go for lakhs. 15 into 100 divided by 17. Round it off to a easier value and that would act as your weight. 0.88 would be for your equity. So 0.12 will be for WD. You want me to solve it and show? Now you try, in next class I will show. See, it is easy. You have KE values here directly given. KI value is nothing but it is 10% for all the four firms. Okay. Now weights, how we calculate is 15 lakh is how much of the entire, or you can do 2 lakh is of how much for entire 17 lakh. See, it will be different for different companies because the firms are different. Okay. See, for second one, how much? What is 15% of entire 21? 15 into 100 divided 21 into 15 into 100 divided by 21. What is it? Ah, if this makes up 71, the rest 29 would be 6. Or you should take it as 0.29, 0.17. So this is easy. It would be 0.50. Out of 40 lakhs, it is 20 lakhs each. Yes, it stands at 0.50. So what is the last one? One. So the last one would be 45%, and the next equity would be 55. So now, since you have given assigned the weights, multiply with cost of equity and cost of debt to get the weighted average cost of capital. Weights of each for firm X. What is the weight of equity? Point. What is the weight of equity for firm X? It is 0.88. Yes. If the weight of equity is 0.88, the weight of debt would be 0.12. For firm Y, the weight of equity would be 0.71. So the weight of debt would be 0.29. For firm Z, the weight of equity would be 0.50, and if half is weight of debt, the other half would represent the weight of, if half represents the weight of equity, the other half represents weight of debt. And for the last one, the weight of equity is 0.45 and the debt would be 0.55. And the weighted average cost of capital stands at 11.76, 14.29, 12.5 and 13.64 for firm X, Y, Z and A. See, so that is the end of the problem. Now, even though K naught here, cost of capital and weighted average cost of capital is same, when they have asked, you'll have to represent it in the same. Give the working note if necessary, give the conclusion. And for this particular session, we shall